Can we build our own multi-cap fund using only index funds? No active management, no stock picking, no fund manager risk, just a clean rule-based portfolio. I actually tested this across 4 years of data and the results honestly surprised me. Friends, here is why I even started thinking about this. There are way too many active multi-cap funds in the market, and every conversation was becoming which is the best multi-cap fund. That question itself makes investing a lot more complicated than it needs to be. Friends, and if you look at the last decade, something becomes very obvious. Every year, the so-called best fund keeps changing. One year it's one AMC, another year it is somebody else. No single AMC actually consistently stays on the top. So instead of trying to predict the next year's winner, why not build our own multi-cap fund using index funds? This was my thought process. A simple, transparent, rule-based multi-cap using 3 index fund and 1 debt fund. No guesswork, no fund manager bets, and no confusion. Here is what I created, and this is the fun part. Allocation is 47% in Nifty 100 equal weight index fund, 25% in Nifty Midcap 150 index fund, 25% in Nifty Smallcap 250 index fund, and 3% in ICICI short-term debt fund. And this is very much in the spirit of SEBI's multi-cap rules, but with no bias and zero fund manager guesswork. So how did this do-it-yourself multi-cap perform against actual multi-cap funds? Let's find out. In the 1 year period, the DIY multi-cap did exceptionally well. It bet 8 out of 12 active multi-cap funds. Short-term performance anyway can be noisy, but this is still a very good showing. In the 2-year period, things kind of normalized. Here, the DIY multi-cap beat only 4 out of the 12 active funds. This shows that active funds catch up in certain phases, especially during strong mid-cap or small-cap rallies. Friends, but when we stretch the horizon a little further, something interesting happens. After the 3-year and the 4-year mark, the DIY multi-cap comfortably beats around half of the active multi-cap funds. And this is exactly what we expected from a well-constructed index blend. Steady, predictable, and category-level performance. Friends, out of the 12 active multi-cap funds I compared, only 6 managed to beat the DIY multi-cap fund in the SIP route. Out of the 6, only 4 funds beat the DIY blend with any meaningful margin. Nippon, Kotak, and Axis have done very well. But look at Quant Multicap. It is collapsing in the SIP route, nearly 12.5% below the index blend. This is the most important part. Most of the funds lie between 3 to -3 of the DIY multi-cap SIP returns. So overall, the DIY multi-cap has done very well in the SIP route. Not the best, definitely not the best, but definitely not the worst. And once again, comfortably sitting somewhere in the middle of the category. Friends, now let's look at the rolling returns, the real truth teller. When we check the rolling returns, the same 6 funds which did well in the SIP mode also outperform the DIY multi-cap here. And out of these 6 funds, 5 funds beat the multi-cap fund 60% of the times. Friends, this is where things get really interesting because 2 of these funds, Nippon and HDFC, deliver the consistency without taking the extra mid-cap or small-cap risk. Kotak and ICICI, on the other hand, have historically taken higher mid-cap exposure compared to these 2 funds, which boosts the returns in a mid-cap driven market. So friends, this is the point I'm trying to make here. If you pick a multi-cap fund randomly, there is a 50-50 chance that it underperforms the simple index blend. Friends, before you walk away thinking that this is a perfect solution, there are a few very important limitations you should be aware of. Volatility may be higher. This portfolio uses Nifty 100 equal weight index, which tends to behave more aggressively than its market weighted counterpart. If you prefer lower volatility, you can simply choose to replace it with Nifty 100 market weight index. Number two is rebalancing responsibility is on you. To maintain the 50-25-25 allocation, you need to rebalance at least once or twice a year. If this is done incorrectly, it can actually increase taxes or drag down the performance. So a basic understanding of rebalancing strategy is required. Friends, number three is no tactical decisions like sector bets. This is a rule-based structure. So if you want to make sector bets like overweight on banking or underweight on biotechnology or whatever, this DIY multi-cap fund won't allow it. Friends, this DIY approach is not designed to beat the most aggressive multi-cap fund. It is designed to help you avoid the worst mistakes and land safely in the top 30-40% of the category with zero fund manager risk. So that's the trade-off. You will probably never be the number one multi-cap performer this way, but you will never be the worst. And in long-term investing, avoiding the worst mistakes is far more important than chasing the best returns. With this DIY multi-cap approach built using the index funds, you avoid the worst funds, avoid luck, avoid stress, and still get solid category level performance with zero decision making risks. Thank you for watching. Be wise, money wise.